This is our Forex blog for April 1st, 2013, and one of the things that we do every day is show some of the easiest ways of trading and how our software performed during this day's market. We go back over probably 2.5 years now, so you can compare any day and see how our tools did compared to the tools you're using. And for years, one of the tools we used was a currency meter to identify statistically which currencies are weak. Like you can see here with the dollar, there's clearly much more weakness than there is strength, the intensity of the downside. We also, underneath that, have the daily, weekly, monthly trend. And recently, within the last month or so, we have come up with indexes that show in chart format what the US dollar is doing, what the Japanese yen is doing, pound, euro. And when you combine them both, and you see, for instance, that the dollar is underneath the index's hourly moving average, the previous day's low is right there, the point of control the previous day and the previous week is there. Previous day's point of control fell 4 pips, previous week fell 37 pips. If it went up, it would have a positive number on there. You can see the euro fell 131 pips last week from the week before. All these things line up and give you an edge. You can see the yen today. Clearly, the previous day's point of control went up 102 pips. It's above its hourly moving average. It's above the 15-minute moving average. It's coming up to the previous day's high and then breaks out right here at 3. You can clearly see the real-time momentum's up. The daily, weekly, monthly trend is up. This is as much of a no-brainer as it gets when it breaks the previous day's high. And you also know, when you draw your fibs on that last swing, where the next likely profit target is. First fib target, second fib target. You can see it just went barely past that before reversing. The containment bands on here also show you where it's usually likely to reverse. Most of the time, price doesn't go through the white 2.0 containment band. So this time right here at 3 o'clock, which one was one of the weaker ones? Well, you can see the dollar was trending down. It was underneath its hourly, and 3 o'clock right here, it just broke down. So one of the trades you could have taken at 3 o'clock, let me move this out of the way here, is selling the dollar yen. Now, this one oftentimes doesn't move too many pips, but when one of them's super strong and the other one's super weak, you're going to more likely to get 20, 30 pip moves. You can see at 3 o'clock this one was already at its lows, broke down, and it fell down to the 30 area from the 80 level. That's an astronomically big move in 1 hour for the dollar yen. And it was predicted and telegraphed before the move happened. You have the first fib target, second fib target, and it's underneath our lower containment bands likely to reverse. We also have our perfect oscillator, and when the perfect oscillator is below the minus 80 level, or for upper moves above the plus 80 level, typically you either get a sideways movement and then a later reverse, or in this case a reversal. And so when it popped back above that lower Bollinger Band on the perfect oscillator, this is where it's likely to start reversing. You can see that happen right there on this bar right here. Actually, next bar right there. On this bar, when it popped back up, you get out of your trade, and I wouldn't do a counter trend trade in something this week, but you made close to 50 pips on that one. Another one that was trending up today, although the odds of it really exploding up is low because of the daily, weekly, monthly trend all being down, is the euro. You can see when a currency is trending up and it's above its hourly, buying it on the chart when it hits the lower Bollinger Band here, 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 it went below it here, here, all high probability places. Let me put little circles on here so you can see it. When a currency is above the upper or the hourly moving average right there, you want to look for buy. Okay, so once the currency is trending up and it breaks from below to above the hourly moving average, usually when the lower band gets hit, it's a pretty decent place to be buying. If you notice all these areas where it hits the lower band, if you had looked for buys at that time, 3:30, 5 o'clock, 7 o'clock, against a currency that's weak, in this case the dollar's weaker than the yen, it's underneath its hourly. If you start looking for buys on euro pullbacks at these areas, let's bring up the euro dollar chart, which is one of most people's favorite currency to trade. So when the euro's given a little pullback and the dollar is weak, basically 3:30 was one of those times. I think this was it. There might have been a time here, 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 and here. The point of trading is you're going to have some wins, some small wins, some medium wins, some large wins. You're going to have some small losses, some break evens, and some average losses. And average loss is basically what you initially set your stop to. Let's say it's 10 pips. So occasionally you're going to lose 10 pips. Occasionally you're going to lose 5 to 10 pips. Other times you're going to have break even. Sometimes you're going to lose 1 to 3 pips. But your wins are of variable nature. Some of them are going to be, maybe 10 pips, 12 pips. Maybe this one is a 2-pip win or break even. Maybe this is a 5-pip loss. This one's a 15-pip win. And this one's, a big 40-pip win or more. So when you average out all your wins, you want them to average 1.5 to 2 times bigger than what your average loss is. If you have a ton of break evens and then your biggest loss is 5 pips, well, you only need an average win of 7.5 pips to do well. But using our software, most of the time you're going to catch occasional 30 to 100 pip moves, so that's going to really increase your average win. Let's go to the page that has all the currencies on it, and we'll just highlight some of the places that are pretty high probability. When a currency is trending down and it comes back up to a resistance area like the point of control, previous day's low, hourly, this is a very high probability place to be buying. Just like currencies trending up that has a pullback is a very high probability place to buy at the hourly moving average or the point of control, previous day's high and low, and so forth. You can see here the Australian trending down, came up to the hourly right here, came up to the point of control. This is where most traders have positions in the previous day. Both of those areas are decent places to sell. Let's take a look at some of the other ones here. The pound trending down, comes up to the hourly here, previous day's high and fails. Hourly right here, 2 great places to be looking for sells. And we know that the yen was quite strong from 3 to 6. So obviously if the pound is likely to go down, you want to look for pound yen sells. Weak pound, strong yen. And let's try to find the exact time on that. 4:30, close to 6. Here's 4:30, close to 6. Yeah, all right. So you might had a small win here, small loss, or maybe an average win, because this is you short it when it breaks the low of the previous bar. So you'll be short right there. It comes down a little bit. You can see it hit the lower band of the perfect oscillator, wasn't able to fall off. Let's take a look back at that chart. There's one that I must be missing here on this. Okay. The pound was likely to go down here after 6, but as you look at the yen chart, at 6 o'clock, the yen broke down. So while both of them were falling, the yen was falling faster and more rapidly than the pound was. So if you're watching the index chart and you're in a pound yen sell and you see the yen break down, you got to get out. You want to see the yen go up and the pound go down when you're in a trade like that. Notice that this one just kind of gradually goes down, whereas this one falls like a rock. So it's pretty intuitive how to trade with this. Here's the New Zealand previous day's low right here. When it's underneath the previous day's low, you want to look for sells. Right here, hits upper band here, here. Had a false breakout, came back down again, tested that area, all these places. Now remember, the yen was strong until about 6, and then once it broke back above the hourly moving average here at 10, it was also strong for a little bit. So we'll look at the New Zealand yen short before 6 and then after 10. So we have on this chart, it's down near the lows, has a nice little rectangle pattern right here, breaks down. You can see it fell from 40 all the way down below the whole number. That's over a 40 pip win. And remember, at 6 o'clock the yen got super weak, but after 10 you're also looking for sells, and you can see right here, nice little 30 pip move. And typically once the market sells off, you're looking for a little bit of a pullback to go short. Your stop's above here. Once it starts going your way a little bit, you move your stop very close to break even. You might have had a 5 pip loss there. You're looking to sell this low, never happened. You got a little bit more of a pullback here, you go short, This second trade made 15 pips, and if you're a scalper, you might have got back in again here. Keep in mind that this is after the U.S. main session is over, so most people don't trade that time of the day. But the point is, when you have all these currencies to choose from, you can very easily see which ones are super strong and which ones are super weak. You can also spot patterns such as trend line breaks, like this. Anytime a currency gets hit once, twice, 3 times, and finally breaks the trend line, that's a pretty high probability place to buy the Australian. What was likely to go down, or was going down, at 12 o'clock. You can see kind of Swiss had a false breakout above the high. 12 o'clock. The CAD was also weak. So let's take a look at around 12:15, buying the Australian CAD. One currency has to go up, and the other one has to either go sideways or down to make money in that pair. If one's going up, the other one's going down, you're probably going to make 25 to 50 plus pips. If one's going up and the other one's going sideways, you might make 5 to 15 pips. If one's you get in a trade and it starts going up and it reverses, and the other one reverses, you better get out, because you could have a huge loss if you don't, take the small 5 to 10 pip or 12 pip loss that you initially decided to risk. So let's take a look at the Australian CAD a little bit after 12. Trend lines, double tops, double bottoms, support, resistance, all work on our indexes. So here's 12 o'clock. You can see this one has been above the hourly for a while. It's kind of chopping around because both of them were weak, and then it breaks out right here at 12, and it's not the biggest win in the world. You can see it kind of went up, pulled back, tried to go higher. I would have probably had a trend line underneath here, and if the trade was going to work, it usually will stay and keep trending up. In this case, it didn't. If you weren't out of this trade here, once it pulls back and comes back up, can't break the high, you know for sure it's not going to work once it breaks that swing low right there. So the worst case scenario, if you got out right here and you got in on this breakout, even if you had a wide spread on this, you might have only lost 4 or 5 pounds, or 4 or 5 pips. Let's take a look at some other ones. Notice false breakouts, also very popular, in my opinion, the ways that I like to trade this. If a currency breaks from below to above the previous day's high, that's a trade that's usually going to work. And when it doesn't, when it comes back into the previous day's range, it usually will pull back to the hourly moving average. So at 11 o'clock, the pound is a good one to be selling. So you want to trade it at 11 o'clock against one of the stronger ones. Let's try to find one on here. 11 o'clock, the yen has already been going up, so more than likely the pound yen has already fallen a considerable amount. You want to kind of find a currency right at 11 o'clock where one is just starting to go in new directions. So you can see the dollar is weak, so you wouldn't want to trade a weak pound versus a weak dollar. It's probably going to chop around and not really go much. The euro at that time had just broken out above the previous day's high, and it pulled back, and it was near the lower Bollinger Band. So at 11 o'clock, the euro pound was a very high probability one to be going up. Let's take a look at this one. Euro pound, 11 o'clock. And that's basically how you use this tool, as an anticipatory thing. Here's 11 o'clock. You can see this one's near the low, and it went up 15 pips. In the euro pound, you're basically making a lot more than you are in the euro dollar as far as pips go. It might be a little bit under $20 per pip per standard contract, but it's almost double the amount of dollars per pip. So a 15 pip move is equivalent to a 30 pip move approximately in the euro dollar. So that's a significant move right there. And as you can see, again, pretty well telegraphed in the index. First of all, the pound was trying to get above the previous day's high before. When it did break through there, it barely went up anything. I want to see breakouts over or under previous day's high or low go up on our index scale 10 to 20 pips. In this case, it only went up 5. It pulled back, found support here. That's normally a pretty decent place to buy, and if you had, you're expecting this high to be broken. If it doesn't break that high, you got to bail. And what I oftentimes do on trades that don't work, that usually maybe 60 to 70% of the time do work, is I get out of the trade with a small loss, small win, break even, and then flip and go the other way, because the momentum is, everyone is expecting that trade to work. They all realize it's not. Not only do they bail, so there's a ton of selling in pound pairs, But you also have people that recognize false patterns. You know, when you know a bunch of people are trapped in a losing position or they're about to lose, all the people going in there selling it, you know, causes it to go down. People will capitalize on that. So let's take a look at another one right here. The Swiss was trending up all day. It was at the point of control. You have the previous day's high right here. If it goes through that level at 11 o'clock, it was right near the lower band. So the pound Swiss was an excellent one, very high probability one. Probably made 15 to 20 pips on this at 11 o'clock. Pound Swiss, you want to be selling it. So here is 11 o'clock. You can see it's been underneath the hourly for quite a while. Did have one false breakout low. I would kind of ignore that little bar right here because it immediately came right back up. It spent most of its time in this little range. 11 o'clock, you're looking at this chart as a possibility of one that falls. You'd be short once it broke that little trend line there. Again, anytime a currency just spikes and comes back in, I ignore it for drawing trend lines. You're short right there. You put your stop right above here. So this is what you're risking. And most of the time, if a trade's going to work, you draw your fibs on the previous big swing. You got your fib targets down here as your profit. So as you can see, the profit, even the first fib target, is probably 2.2 times bigger than this. And I'm just going to draw the fibs on there so you can see. Usually I estimate them visually pretty well. Look, it went right to the 1.618. If you got out of your trade there and you're short this, let's say at 30, you made 30 pips. And if you got short here at 30 and you put your stop above here, you're risking 15 pips. You made 2 times more than your risk. And again, like I said before, that's all you got to really focus on. Small losses, big wins, and there's not much more to it than that. You're not going to be right all the time, but if you get into a trade and one currency is not going your way and the other one's not going your way, if they're both going sideways, once you get into a trade, you're all right. But if they reverse, if either one of them reverses, and especially if both of them reverse, you get the hell out of the trade. You know the trade's not going to work. And most of the time, depending on the situation, if you flip and go the other way, you're going to capitalize on the reversal. As everybody else that's in that trade, like you are, all realizes they're losing money and they exit their trade, which causes it to go usually 10 to 15 pips minimum.